Good morning, everyone. This is another in the 10-minute tip series of recorded programs for credit and collection pros. This one is titled Credit Insurance, the Good, the Bad, and the Ugly. Let's go ahead and jump in. As it relates to purchasing credit insurance, in theory, a creditor company can request a credit insurance policy that covers one customer, your potentially highest risk customer, or a handful of customers. But in reality, the insurance company really prefers that they get essentially all of your business, your good customers, your moderately risked customers, and your high-risk customers all bundled together in a giant package that you're requesting credit insurance for. And if you present to them a request for coverage for one or coverage for a handful of customers, what you often get is either they decline coverage entirely or you get a price quote that's prohibitively expensive or high. So in this situation, the insurance broker or the insurance agent is likely to come to you and tell you that the credit insurance company is most interested in and will look favorably on and will price appropriately a policy that covers a mix of accounts. And what they mean is you'll be purchasing credit insurance coverage for low-risk domestic accounts and high-risk foreign customers and medium-risk and high-risk domestic and foreign accounts. And to some of you that potentially haven't used credit insurance before, they might be saying, Michael, that doesn't necessarily sound like a bad thing. We'll be getting coverage for all of our customers. The problem with the idea of presenting a basket of risks to the insurance company is that what you're doing in effect is insuring low-risk accounts, intermediate-risk accounts, and high-risk accounts. In effect, what you're doing, of course, is purchasing credit insurance on customers that you don't think you need coverage for. And then after you've submitted your application, in which you've included a bundle, a mix of intermediate, low, and high-risk customers, often what happens after that, even after the mix is submitted, the insurer will deny coverage for some of your customers. Not all of your customers, of course. The customers that are likely to be denied coverage, of course, are the high-risk customers that you've submitted for review. To illustrate this, I'm going to offer you one example. So let's just assume, for convenience, that you've identified just 10 customers for which you're now requesting from the insurance company coverage limits in excess of $50,000. And assume that this, on the next slide, is the response that you get from the insurance company to your insurance application. So we see three columns. You have the customer, I've used a number. You, of course, would use the customer name. Then you have the amount of coverage you're requesting from the credit insurance company. And the third column is the coverage that the insurance company has approved in connection with these named accounts. So the first one, you got full coverage. The second one, you requested $110,000, and you received a quote in which the limit would be $70,000, $120,000, $95,000, etc. Now, it probably doesn't come as a surprise at this point that the customer's not approved or approved for a lesser amount of coverage than the amount you requested based on your credit limit or your sales forecast are likely to be the highest credit risks. Unfortunately, the decision about whether or not to purchase credit insurance is never going to be simple, it's never going to be obvious, it's never going to be intuitive, and it's never going to be formula-driven. The challenge fundamentally, and this is a common occurrence for creditor companies considering a proposal from an insurance company, is whether or not to purchase the policy, to buy the coverage knowing about the coverage reductions as they relate to the named accounts that you want coverage for that you either didn't get any coverage for or alternatively you got less than the amount that you needed. And as I mentioned, there are no simple answers to the question of should we buy this policy. There's no formula, there's no math, and nothing can be applied to the scenario other than common sense is the best thing that I can use to describe how this decision process is made. But unfortunately, coverage limitations and exclusions aren't the only problem that we need to take into consideration when we're evaluating their proposal. And by the way, if that was the only issue, it would be complex. But let's add an additional layer of complexity. We have to factor in the annual deductible. So in addition to the premium, in addition to the exclusions, there's an annual deductible. Let's just say it's $250,000. And what that means is the first $250,000 of bad debt losses on covered accounts that you incur is yours. You don't receive, you can file a claim, but you're not going to get anything back from the insurer because you haven't met your annual deductible. So that's a layer of complexity on an already hard decision to make. And the decision about whether or not to purchase the insurance policy becomes even more complicated when we have to factor in whatever the negotiated per loss deductible is. Because the insurance policy will have an annual deductible as well as a per loss deductible. Let's assume that it's a 20% deductible. So you have a loss, a bankruptcy, for example, that it results in a $100,000 bad debt loss. You submit a claim for $100,000, and at that point, when you submit your claim, what you get, of course, is 80% of that, because 20% is your per loss deductible. And then yet another layer is added because there will be in the insurance policy an annual dollar limit or cap on the total amount of claims paid. And let's just assume it's $3 million. So the annual dollar cap on claims is $3 million. You can continue to submit claims for losses that occurred in the year in which you have the insurance policy coverage. But unfortunately, if the total aggregate losses that have been submitted and paid by the insurance company exceed $3 million, then the annual dollar cap on claims payouts comes in and they are no longer required to honor those claims. In addition, another complexity in the decision-making process is the idea that in many policies there are sub-limits. For example, there'll be a country-specific cap on coverage or a country-specific cap on payouts based on the risk of doing business in that country. Or a particular business segment potentially might have a dollar cap. It might say, as a very simple example, the dollar cap on losses that will pay involving retailers is $1.5 million. So no matter what, even if we approve the customer, it's a named account and the dollar amount of the coverage is what you had requested and you are submitting a claim accordingly, our maximum obligation to pay claims as it relates to retailers is $1.5 million. Here's my perspective. A decision about whether or not to purchase a credit insurance policy wouldn't be easy, wouldn't be obvious, even if the insurance company approved every coverage limit you requested on all of your customers, including the high-risk customers. Of course, that would never happen, but why would it still be difficult? And the answer is that you still have to consider the idea that we have to fork out a very significant annual premium. And we still have to meet whatever the annual deductible is. And then what we hope is that the claims that are paid by the insurance company exceed the annual deductible as well as the annual premium. Because only at that point do we start recouping money. Do we, in effect, make money by purchasing credit insurance. Credit insurance is not first dollar loss coverage. It is a risk-sharing model. And fundamentally, there's a couple of things to remember. Insurance companies aren't in business to lose money, and what they're really providing is not what many people think of as first dollar loss coverage. Every time we have a bad debt, we have insurance, we go to the well or the money tree, we shake the tree and money comes out. No, it is coverage for catastrophic losses, or it's intended to be coverage for catastrophic losses, not the day-to-day things that we would normally be able to absorb by looking to our bad debt reserve to ensure it was adequate to cover the types of losses that we normally expect as a cost of doing business with customers on open account terms. Thank you for your time and attention. I really do hope that you found this presentation to be interesting and informative. By the way, if you'd like to hear the entire 30-minute on-demand program on the same topic, please contact my sponsor, the Wisconsin Credit Association. I didn't leave the URL. It's www.wcacredit.org. Thanks. Have a great day.